As we reflect back on the first quarter of 2023, despite the headlines and some of the volatility in the equity markets, in general, equities finished higher than where we were at the end of the year. In North America, this means that equity markets in Canada and the United States were modestly higher in the low to mid-single digits, whereas overseas we saw particular strength in Europe and the emerging markets in general. Now, we can't talk about the first quarter without highlighting some of the banking risks that we saw in the United States as well as Europe, and these did contribute to some of the volatility that we saw later on in February and early into March. Yet, despite some of the issues with the US banking sector, overall equity markets managed to finish the quarter on a positive note. When we turn our focus to fixed income, we believe we've seen the peak in the interest rate cycle for Canada as well as the United States. That is, the Bank of Canada has indicated a pause in any further interest rate increases, and we believe the US Federal Reserve has come to the same conclusion while not outright explicitly announcing that. Now, this is all in response to inflation that continues to trend lower. Overall, we've seen bond yields fall during the quarter, which is a benefit to bondholders as the value of the bonds tend to increase. In addition, what we've seen through the first quarter of 2023 is that as equity markets tend to see downside volatility, fixed income markets tend to perform to the upside. This returns bonds to their more defensive characteristics within portfolios and should bode well for investors through the remainder of 2023. As we look ahead, we do have to recognize the increased risks of recession towards the end of the year. That is both in Canada and the United States. We believe, though, that we can still see a soft landing with respect to the economic contraction, and that is going to be supported by a still very, very strong labor market in Canada and the US. In general, from a portfolio perspective, we remain a little bit more defensive, and that is within equities focusing on valuation, the cheaper valuation that we can find in the international markets as well as the emerging markets, and a slight overweight to fixed income. With bonds having returned to a more defensive posture within portfolios, they should provide a little bit more downside protection and in the meantime, offer an attractive yield for investors.